And a big warm welcome to Breaking the Mould. I'm Clara Hermit and this is Russ Mould, our Investment Research Director. Russ, it's that time again. What is the fuss?
The fuss this week, Clara, is all about government. No, don't pull a face. I know you can't invest in government PLC. Some of you probably wouldn't want to if you got the chance. But don't forget that coalition policies can and will impact upon stocks that are involved in your portfolios. And William Hill, the high street bookie, great example potentially. They have a trading statement out today, Friday the 17th.
So what will Ralph Topping, the CEO, be saying today?
Well, there are two issues he's going to be addressing. The first one is there's a potential government clampdown on fixed odds betting terminals, fruit machines in common parlance, or gaming machines. Big source of profit for the bookies. Leader of the opposition, Ed Miliband of the Labour Party, is calling for a clampdown on planning for high street bookmakers to combat what he argues is a problem or a gambling addiction issue related to fruit machines. Secondly, the government is already considering closing a major tax loophole. If you log on, place an internet bet at home on a dog race or a horse race or a football match, the bookmaker isn't, and you lose, possible, the bookmaker won't pay tax on the profits he or she makes, even if you're based in the UK, so long as their online business is based overseas. Gibraltar's quite popular, for example. The government's getting a bit fed up of that and quite fancies generating a few more quid in tax.
So does that mean that for once the bookies are onto a loser?
Well, there's certainly been some nasty share price falls, if you'll pardon the expression, over the past few weeks. Barclays has actually done a study looking at what the impact of a gaming machine tax would be, and the stockbrokers' research suggests that Ladbrokes could be the worst affected, followed by William Hill and then Irish bookie Paddy Power. So we need to keep an eye on that. There's nothing planned yet, but Labour are pressing for it. In terms of the point of consumption duties, it's rather grandly called, this online wagering tax. The government wants to get that in by around Christmas time. So we'll have to see whether it happens or not. Again, the bookies can respond. I mean, clearly they can cut costs. They might choose to cut marketing or sponsorship expenses. They've also got the World Cup to look forward to, a big potential betting bonanza. So it isn't all lost for them by any means, but their share prices could well remain volatile for the next few months.
So what about the broader issue of regulation? Because I know the source of all the fuss, as you said, is the government, but what other industries are going to be affected?
Well, banks are clearly constantly in the firing line. It's nearly 7 years since the financial crisis started and really got going 6 years ago, but the banks from the regulator are still being pressured to hold more cash on their balance sheet so they don't get into financial difficulty and customers feel safe, and I think everybody understands and feels comfortable with that. Some of the support services companies like Serco and GFS are getting a bit of a rough ride. There are allegations they've overcharged the government for electronically tagging criminals. The government, as a big customer, is understandably not best pleased, and there's talk of it taking some contracts away or not renewing contracts when they expire. So that's certainly two more sectors to watch.
What other sectors should we be having a look at?
Utilities is actually the big one, so it's right of you to remind me about that. Clearly, all consumers very frustrated by the big price increases that were announced last autumn. Ed Miliband got onto that one in his Brighton Party conference speech again. He's hassling the government and the companies about this, promising a price freeze if he wins a general election. That's going to put, in terms of pressure on SSE, the utility. There is talk it may need a rights issue if there's a price freeze. So that's a share price that's likely to remain volatile, for example. Another potential football, transport. Somebody whose train was late this morning. It's clearly a big issue for commuters. And again, price rises are a big deal. So Go Ahead, National Express, First Group could find themselves being used as vote-winning machines, depending on how the run-up to the general election goes in 15.
Okay, Russ, that is enough.
Okay, I get it.
Of politics
I get it. That's
for today.
fine.
I've just had enough. What else have we got to look forward to?
Central banks. Okay, maybe next time I'll need to do something a little bit better. Maybe we'll try. But no, it's going to be good because it's the first Federal Reserve meeting under Janet Yellen and Stanley Fischer, the new vice chair team. The market's expecting a $10 billion further tapering of QE down to 65. And that's despite a pretty sloppy employment number. We talked about the non-farm payrolls last time. It was supposed to come in at 200,000, came in at 74. Weak number, but there's still this expectation the Fed's going to try and gently withdraw a little bit more stimulus, but still remain accommodative. Bank of England minutes come out the week before, the 22nd. Under Governor Mark Carney, the votes have always been 9-0 against changing interest rates, against increasing or decreasing quantitative easing. Now, unemployment's hopefully coming down fairly quickly. In fact, it's coming down quicker than the bank thinks, near the 7% threshold. Will one of the Bank of England committee members start to vote for a decrease in quantitative easing? Might be a bit early, but it'll be interesting to find out.
Okay, Russ, thank you very much. Hopefully you'll be able to digest all of that information. We'll be back with you in just 2 weeks' time with a whole lot more. Take care. Bye-bye.